Quarterly magazine, still in print, and also a huge group on LinkedIn. I think over 50,000 members and 25,000 readers of our newsletter. So today we have a 60 minutes live webinar. We talk about forecast value add, and although I hate the phrase thought leader, we actually have a thought leader on this topic. So I will introduce him. So I have next to myself, I have invited Jonathon Karelse. He is a founder of NorthFind Management, and he has a background in economics and law. And maybe, Jonathon, you can explain why you are attracted to forecast value add as a subject.
Yeah, thank you, and pleasure to be back with you. The thing I love about forecast value add, and by the way, I hate the phrase thought leader as well, is because I think of my background in economics before I got into supply chain, and I was involved corporately in finance before I was in operations. I've always been interested in understanding how the things we do operationally ultimately impact the P&L and the balance sheet. And the thing about forecast value add, when done properly, is it really gives us an insight into where is our financial return on each of the things that we're doing to generate a forecast. I'll leave it at that because we have some slides to go through to get into more detail. But really, this highlights not just is my forecast good, but more where is my forecast generating business value for my shareholders.
All right, and forecast value add has been introduced, I think, in 2002, and you were one of the first, so if not the first, practitioner where you have applied this concept.
Yeah, so this is where I will happily accept the mantle of thought leader, because yes, when Mike Gilland, who at the time was with SAS, introduced the concept of forecast value add. When he introduced it to me, I was relatively new into my tenure as a demand planning leader at a Japanese automotive parts company. Concurrently, I was developing a cost of inaccuracy metric for our organization. And when he talked to me about forecast value add, I married his approach, which looked at the relative performance of each part of a forecast, with my approach, which was the cost of inaccuracy, to really come up with this sort of ROI picture of where is the forecast creating more or less business value. And for any of your listeners who think this is just random bragging, you can take a look in Mike Gilliland's book, The Business Forecasting Deal, published in 2005. You'll see he lists me as the inaugural case study there. Really happy to have been working with Mike for 20 years on this.
That's good to know. So we will talk about it in depth later on in this next 60 minutes. We'll talk about biases, we'll talk about forecast accuracy and inaccuracy, the cost of it, etc. Practical things. This webinar will be recorded, or is being recorded, and it will be made available on YouTube within 48 hours. The PDF will be made available. A lot of good stuff. It's like a lecture, but in a good sense. And then also, the audience is on mute, so you see the chat functionality on the right-hand side. I won't track it because the first question will be, is it being recorded? Yes, it is. I will track the Q&A functionality. If these questions are online, Jonathon is talking about, I will ask these questions immediately. If not, I will reserve the question till the end when we have a Q&A, if we still have time. If we don't have time, we still have time here, and Jonathon and I will be in a virtual lounge, and so we will be there. As of this point, we will be putting off our camera as of now, so you can enlarge your screen and have a better look at your slide. Jonathon, you can put off your camera so you can have so people have a better view on the slides. All right. First, Jonathon, can you tell us a bit more about NorthFind?
Yeah, sure. So, like I said in the brief introduction of me and forecast value add, NorthFind has been created in a similar way. Our team are all practitioners who have backgrounds first in finance, who have found ourselves in operations over the course of our career. And in a nutshell, we're an operations management team, really relentlessly focused on generating business impact rather than just operational outcomes. Often those two are aligned, But in our case, we always can be very clear about what the operational impact, the financial impact of operational work is. One of the cornerstone practices of our team is sales and operations planning. One of my personal areas of subject matter expertise is demand planning and supply planning, but we go up and down the supply chain from procurement to finance scheduling and process design.
And you see incredible, well-known names. So these are all customers of yours. You were working with.
Yeah, for sure. And what we're really proud of is to this day, a prospective client or anybody interested can choose any of those logos on our website or from the deck, and we're happy to give them a point of contact there to ask what the work has been like working with us, because we really make it a point of pride to make every single engagement a case study. So not just making sure we deliver the boxes on the statement of work, but to make sure that every engagement really drives transformation and ultimately success.
Let's take a look, at the world. It's quite turbulent nowadays. So this is an overview I'm using regularly, in a sense, what our CEOs are talking about. And this is an overview of the phrases CEOs from Fortune 500 companies are using in their analyst calls every quarter. And this one is about the Q2 of 2025. And you see, agentic AI, tariffs, supply chain. Supply chain has been there since the start of COVID, when they started all this. So what's your take if you have a look at this?
I think it's interesting. And I think it's interesting to see how some of these conversations migrate over time. I think on the one hand, it's worthwhile to sort of keep abreast of these conversations. On the other hand, for any of your listeners who have watched the show House, I'm kind of with Dr. House and saying people lie. I think when we talk to people, they'll often tell us the thing they think we're supposed to hear. Like in 2019, just before COVID, EY had a survey of global CEOs, and at that time, something like 89% of them said that risk management and supply chain redundancy were top of their list for 2020. Clearly, that wasn't the case a few months later. But nevertheless, I think it's pretty interesting here just to see where some of these hot topics like agentic AI are moving, and how other sort of brick and mortar type of things like supply chain relate to them in terms of virtual importance.
So when I look at this in the context of the webinar we're having right now, the most remarkable phrase related to forecasting and demand planning is uncertainty. You see, and totally on the right side, and that it is out there. So CEOs are they talk about uncertainty, and that's also the topic of this webinar. All right, so there's a lot of uncertainty, there's a lot of turmoil, but then again, what are the expectations of customers?
Yeah, exactly. And I think before jumping into FBA, it's good to sort of level set on why is it we're forecasting in the first place. And some folks might think, well, this is pretty rudimentary. I mean, of course I understand this, but honestly, I think it's a discussion worth having, because a lot of times I think we go through the process of certain operational activities like forecasting because it's a thing we're supposed to do, and we kind of lose sight of the original reason why we're doing it. So in this case, a customer expectation, if they walk into a coffee shop, is they want immediate gratification. I want a coffee, I want it now. They don't really consider that the actual procurement, the cold start procurement lead time of that cup of coffee is probably nearly a year, from growing the agricultural product to picking it to shipping it, etc. I mean, you're looking at an extended supply chain time of, it says 90 or more than 30 days here, but in reality for coffee, depending on where it's coming from, it could be north of 270 days. So really, the gap between what our customers want from us and their expectation of responsiveness and our ability to meet that responsiveness is something that we try to close or mitigate by guessing in advance what they need and when they need it. And really, no matter how complicated we make the process of forecasting beyond that, that's essentially what we're doing. We're trying to guess in advance what people want from us, so we can have materials in place, so we can have capacity in place to meet that demand in a time frame that meets their expectations.
And
the reason we go ahead.
And how good are we at guessing this?
Yeah, not good at all. We've been trying to predict the future for a long time, and there's a lot of data from trend watchers that shows that even despite all the advances in technology, um, baseline forecast accuracy hasn't really budged a lot in decades. You'll see headlines about new ML models and forecast competitions, and there's cool new breakthroughs. But at the street level, where you've got real practitioners and real business and real data, we're not seeing a ton of real improvement. And what that's doing to a business, and like you're showing here on the slide, is every time I'm over guessing on my forecast, I end up impacting cash flow. I impact having physical space limitations in my network, and I end up incurring carrying costs. And on the flip side, when I get it wrong on the low side and I don't have those materials in place for the people who want it, it's costing me revenue. And then in the long term, it's costing me my reputation as a supplier, which has even more expensive implications to try to get back. So every time I guess wrong, which is literally every time, there's a financial implication. And this really leads us to what the next slide is. The reason we forecast ultimately is to make more money. Now, there's all these other things we can do with the forecast. We can get better at cash flow planning. We can put marketing in a proactive position to develop programs. From a production planning standpoint, we can stay ahead of favorable factor prices like labor, raw materials, etc. Blah, blah, blah. Bottom line is, we're doing this to make money. We're not forecasting for forecast accuracy. And this distinction is super important. And I'm really going to highlight this as we continue the conversation.
So I was wondering, if I look at this, all these things, supply chain planners, let's talk about supply chain planners as a whole, they are doing this for other functions, but are
Yes.
they enough aware of what they're
No.
doing this for finance, for
No.
sales, for marketing?
No, definitely not. I think if I had to highlight the number one thing, the number one insight that we leave behind with most of our clients, especially when we're engaged with operations folks, it's really helping them understand what the financial impact of their operational activities is. Really understanding, what is my impact on cash conversion cycle or return on invested capital as I flex my inventory? What's my impact on EBITDA and on net profit as I'm flexing inventory to meet better in-stock rates or service levels? I think the amount of financial literacy in operations, frankly, it's something that has gone for too long under-recognized as a critical component. A lot of times we're just doing operations as operations.
I totally and recognize it totally. Another thing is, if you look at this, okay, in the near future, we will expect that forecasting could be done by AI, etc. And possibly and hopefully, the planners are more apt and used to connect with the other functions to get insights for improving the forecast.
Yeah, for sure. And really, that's where we're going with ultimately when we jump into forecast value add. It's understanding how are all these different things that I'm doing to make a forecast either generating me shareholder value or taking it away.
Yeah. So about forecast, are we getting it right?
Yeah, that's a big question. In a nutshell, I would say the forecast is going to always be wrong, and I'm certainly not the first demand planner to say this. Probably the first person to say it formally was George Box, who some of your listeners will recall is the co-author of the Box-Jenkins method, or ARIMA. Probably one of the most important statisticians of the 20th century. He was a fellow of the Royal Society. But what George Box said about forecasting, or actually about statistical models, that all models are wrong, but some models are useful, is actually only part of what he said. And this is really critical for what the value of forecast value add is. Box said, since all models are wrong, you should be aiming for parsimony or simplicity in model selection. So whereas it feels intuitively correct to choose really expensive, complex software, and the number of clients we've worked with who can't do basic statistical forecasting, but are really, really interested in integrating macroeconomic variables, I mean, it's unbelievable. You're still going to be wrong. No matter how complex your model is, you can't predict the future. So you need to be aiming for minimum viable solution, number one. And the second thing he said was, you're going to be wrong, so don't sweat the mouse-sized errors when there are tigers around. And what this really means is the number of companies who are, for instance, arguing over a couple of % of change in a particular SKU at 6 months into the future, when their demonstrated forecast error is 40%, it means they're spending all this time, which is money, trying to change something at a scale of intervention that already falls inside their error margins. The point here is you're going to be wrong, and it costs you money to forecast. So make sure that the things you're doing in forecasting maximize the probability of not only being as correct as you can, but being as correct as you can subject to a positive financial impact. So in other words, if I could improve my forecast by 5%, and in doing so, that had an enterprise value of $250,000 a year. So in other words, 50,000 per point of inaccuracy improvement. First of all, I'd have to calculate that, and we'll talk about that later. But to get that 5% lift in forecast accuracy, which by the way, is a very large lift, it would cost me a $3 million implementation of software, and then another recurring $300,000 a year in licensing, and then the people to run it. Yes, my forecast accuracy would be improved, but it's a bad business decision because I'm only getting a $250,000 return for a $3.3 million investment. So for demand planners, it would feel natural to do everything they can to try to improve forecast accuracy. But the point of forecasting is to, like we said earlier, operate more profitably. So in this case, it would actually be correct from a business standpoint, and this will definitely make some of your viewers uncomfortable, to say, I'm going to live with 70% accuracy, even though I know I could get to 75, because it's going to cost me less financially to stay where I am than to try to improve it.
Yeah. So I see some questions that chat functionality. One question is about, the horizon. We'll talk about it later. So, I will track the chat. So obviously you're using the chat functionality instead of the Q&A. But let's move on. So you mentioned, and this is a white paper, the cost of inaccuracy.
Yeah. So I'm not going to spend a lot of time here because we're talking about forecast value add today, but this is really one of the key components that when folks who have rediscovered forecast value add and are now talking about it online on LinkedIn and are calling themselves thought leaders talk about it, they're missing the entire point of forecast value add. They're talking about forecast accuracy as though that is forecast value add. Value add only happens when I've created value in a business standpoint. And to do that, I need to be able to calculate what my baseline cost of inaccuracy is. So because we don't have time today, suffice to say, we've got a methodology that is a quick and directionally correct heuristic for what does it cost me for each point of inaccuracy per SKU. And we've got a white paper that folks who are interested can download for free from our website to show you how to do it at home. But really, this is a critical piece, even before forecast value add, to understand what is my forecast doing to my business.
Great point. We could talk a whole hour about it, but we'll talk about forecast value add. So first, explain what it is, and then we have a better conversation because I got some questions.
Yeah, absolutely. So like I said in the beginning, forecast value add was an idea that Mike Gilliland, who's now with the International Journal of Applied Forecasting, and at the time was with SAS, he published this idea in Supply Chain Management Review in 2002. And basically, his idea was forecast accuracy is an interesting metric, and it tells me something about the overall performance of my process. Forecast bias is an interesting metric because it tells me something about what the impact of my inaccuracy is going to be on my business, i.e. if my bias is high, it's going to drive inventory. If my bias is low, it's going to drive stockouts. But it doesn't tell me anything really from a root cause and corrective action standpoint. And really the easiest way to highlight that is looking at these two example forecast models. And first of all, I wouldn't advocate for either one. It's just a show. In one case, we've got a very simple model where you've got some demand history, a statistical engine, and then analyst overrides. And the other one, a very complex and cumbersome model. But at the end of the day, if I'm only looking at accuracy and bias, it's just telling me net of everything I did in either this simple or complex model, this is what the end result is. It doesn't tell me how to make it better. What forecast value add does is it looks at what the relative impact of each of these different components of the model was on creating that forecast accuracy. So if we go to the next slide, what it shows us in a table is what the relative value of each of these elements was next to the previous element in the forecast step. So we begin with a reference forecast or a naive forecast, and then we compare how much better or worse was the stat forecast. And this is just an example process. Then we compare how much better or worse were the analyst inputs on that stat forecast. Then we compare how much better or worse were the sales inputs, the customer inputs, and the consensus forecast. Now, this tells us something about every element of the process. And in this example, we can see the stat forecast added value versus a reference baseline. We can see the customer inputs. This is unrealistic because customer inputs are usually terrible. But in this example, customer inputs made us a bit better than sales inputs. And then in the consensus process, which is really crazy because that's also a terrible practice, we got a little bit better as well. What we learned from this is, where are we getting better? Where are we getting worse? We don't want to dump an input, after 1 or 2 months of negative performance. But what we do want to do is, if we have something like, for instance, sales inputs, which a lot of operations folks love to throw rocks at sales, but sales does probably understand the customer better than anybody. If sales are continuously lagging the stat forecast, let's fine tune what the sales folks are looking at and who they're talking to, because there should be value they bring to the process. Now, this level of forecast value add is something that a lot of people who are looking at it today understand. They're saying, okay, I want to look at my stat forecast. I want to look at my adjustments and see if my adjustments are better. A lot of them aren't going as granular as this, which defeats the purpose. We really need to understand every single element so we can fine tune. But as we'll see on the next slide, it's really only when I tie my cost of inaccuracy to this that I really then understand, where am I driving value. So in this example, if my cost of stat forecasting annualized is $300K, which is obviously very, very lean, and the cost of my analyst inputs is $85K, et cetera. So I've assigned a cost value to each of these inputs. And then I can look, because I've calculated my cost of inaccuracy. And in this case, like it says below, we're assuming that our cost of inaccuracy based on the calculation is $8,700 per month per SKU. Then I can look at my annual impact versus the reference baseline for the stat forecast is about $500,000 to the good. And that's against a investment of $300K. So net, my stat forecast is generating $200K in value. Mm-hmm. All of the other steps, net, are actually costing me money. So if we looked at the consensus forecasting process, for instance, yes, it's a little bit better than the customer inputs, and it's a little bit better than the sales inputs, but versus the reference forecast, which is using something like a moving average and costs nothing, it's not making me any better. So the total of all my costs leading up to that point is $500,000 already, and it's generating no financial lift and impact. So although, again, and we know this from the endowment effect in behavioral economics, it feels like we're generating value because we're doing all this stuff. We're stat forecasting, we're getting inputs, we're getting sales inputs, customer inputs, we're going through this consensus meeting. We must be getting better. Net, we're just as good as a basic reference forecast, and it cost us $500,000 to do so. So in this example, if there was nothing else we could do to improve any of these discrete input lines, we would actually be better off from a business standpoint to just continue using a moving average. Yeah. I want to be crystal clear for your listeners. I am not advocating for a moving average. I'm not saying this is what you should do, but this is how forecast value add really adds benefit. When we're
So
able to look at the impact here, we can make these kind of informed decisions.
So I got a question related to this, from one of the listeners, Yuri. When forecast is about making money, how come senior sales management finds it very hard to come up with some consistent numbers? RLTs, 4 to 10 years forecast changes 100 degrees every 6 months. So
yeah, well, it's a good question, and it's a question that I hear every single time I'm speaking at an event or at a webinar, which basically boils down to, why do salespeople always give us crap forecasts? I'd like to parse the two parts of that question. Since it's about making money, yes, it always has been, but in a lot of organizations, people don't really understand that. That's number one. So yes, it is, but a lot of organizations look at forecast accuracy or the forecast process and believe that the KPI is accuracy or bias. That is not a KPI. That is a process diagnostic metric because it doesn't say anything about business performance. So highlighting the connection to finance is something that is true, or that exists, but too many organizations are not doing it. First half of the question. Second half, why do they have such a difficulty? It's because it's hard to predict the future. And depending on how the organization is structured, they may have conflicting motivations for providing the most accurate forecast. So if my only metric for success for sales is revenue, and in a lot of organizations it is, and they don't bear any of the risk for inventory, even if consciously they're not being, let's say, devious or Machiavellian, at some unconscious level, they recognize there is no risk to over forecasting for them. So because the only thing that matters in some organizations is revenue, I'm going to always forecast high to make sure I always have the inventory I need, because that's the only thing that matters to the only metric that I'm being measured on. We're going to get there. It's an excellent question, but really it comes down to the kind of unconscious biases that we're placing on actors in an organization without even thinking so, that lead people to these sort of skewed and unobjective outcomes. But even if we had motivations and metrics properly aligned, having been in sales shoes, I don't like to beat up on them too much. It's a hard thing to predict the future, and even if I'm doing a great job, I'm still going to get it wrong.
So maybe you can tell us about best practices. What are the examples?
Yeah, I will be perfect. So number one, the thing that forecast value add immediately highlights for everyone who's using it properly is what's making my forecast better or worse. But I'm only able to do that if I'm measuring every element that goes in. We work in a lot of organizations where, for instance, customer forecasts are sacrosanct. Like, they'll just blindly use these forecasts because it's the customer, they think, telling them what they need, so it must be correct. And I'll tell you, this is a true story. We were working with an organization once, like a couple of $1 billion manufacturer of specialty wheels and tires. And look at their forecasting process, because they were driving a ton of inventory, but they also still had stockouts. And we wanted to understand, where's all this excess inventory coming from? And they were sure it was the forecast process. So we looked at the overall process, and they had 176 customer inputs coming into it, very tightly aligned with their supply chain. But no one was looking at the accuracy of these customer forecasts. And they had a very, very large, well-known agricultural equipment company as a customer who was providing them forecasts, who was only 50% correct in terms of use requirements at 1 month out. Now, the lead time was 3 months, going to the earlier question we had on the chat. So 1 month doesn't really add any value for me. I'm making my calls 3 months out. So being 50% right at 1 month is no benefit to anyone. So when we went to this customer and said, listen, help us understand how you're generating your forecast, because if we look at the statistical trend of what your requirements are on a monthly basis, we can hit around 68% accuracy at a 3-month horizon. Currently, you're at 40. And the customer said, what forecast are you talking about? everyone's looking at each other and they're saying, well, you're giving us a forecast on EDI on a monthly basis. And this customer said, we don't know what forecast you mean. And then someone in the room says, oh, yeah, I think Bill was experimenting with setting that up, but he's not here for 2 years now. So they had this zombie EDI signal that had been generating a forecast for all their suppliers, which some of their suppliers, like our customer, our client, were using blindly because they assumed it would be correct. And it was generating demand prompts in their live MRP environment. This is a true story that was costing literally millions of dollars a year. If you aren't measuring everything that goes into your forecast, you are quite possibly, more probably, running the risk of integrating information that is absolutely devaluing the benefit of your forecast. So that's number one. Number two, you need to know what the financial cost and benefit of every element is. Because even if it looks like you're generating forecast accuracy, if the cost of generating the accuracy outstrips the benefit of the accuracy, it's bad business. Number three, don't overreact when you're doing FEA. You're going to see months where sales inputs or customer inputs are worse. You're going to see months even when the naive forecast is better than the stat forecast. Things happen, right? The market fluctuates. There's going to be months where everybody got it wrong. You don't want to start throwing out steps of your process because you had 1 or 2 bad months. So FBA is used, again, as a diagnostic metric rather than a scorecard. We want to use it to give us insight so that we can course correct, not make rapid adjustments. There's a lot of conversation around the most appropriate error metric. So what reference error metric should we use in FBA? And ultimately, it doesn't matter. Now, you're going to see people on LinkedIn who are, it seems they've devoted their career to talking about how bad a metric MAPE is. MAPE has some well-known, well-publicized deficiencies. It's not perfect. No error metric is. But at the end of the day, whatever the error metric you're using is, just keep it consistent as a reference. And ultimately, it doesn't really matter that much in real life. The only place that error metric conversations matters is for academics and consultants who are trying to make a name for themselves as a thought leader and don't really do it very much in real life. And the final thing is, we want to limit human judgment to specific cases. We're going to be talking about this because this is a super important consideration. A lot of places, a lot of people, we ask for input and insight, and like the question we had in the chat, well, you know, if it's all about money and sales is all about money, why do they have such a bad job giving us a good forecast? But the problem is, even if they're trying their best, humans are pretty bad at quantitative analysis, except in specific cases. And the number one area that humans are bad at quantitative analysis is under uncertainty. And Martijn, you said at the beginning of this conversation, when we're talking about forecasting, we're talking about uncertainty. So we're in a really bad place for humans to do a good job. And there's 4 decades of research from folks like Paul Goodwin and others who have shown something like 80% of human inputs to a statistically driven forecast process take away value. So we need to really be specific about where do we want to add human judgment so that the probability of a positive impact is maximized.
Yeah, before we get to the statistical forecasting issue, I got a question. You know, maybe you can answer right away. Can you speak about cases where FEA is percentage is positive, but financially impact is negative?
Yeah, thank you, Jeff Baker. He and I go way back on the FBA conversation. Nice to hear from you. I promised the audience that wasn't me seeding a question with Jeff. It's a good question. Yeah, for me, the number one place where we in practice see FBA being positive, but financial impact being negative is in software. In a lot of cases, the incremental shift from, let's say, a basic software tool to a very complex software model where it's costing me incrementally $1 million or $2 million of implementation plus licensing plus maybe specialists or analysts running it. And if I'm only getting on average 1 or 2% more forecast accuracy out of that process and my cost of inaccuracy isn't greater, that's the most clear-cut case. And we see that all the time. Another one is in the consensus process. A lot of organizations feel they have to have this sort of monthly consensus process where they have a bunch of stakeholders talk about the forecast. And if you actually go through what I think is the great practice of costing your meetings, so when you look at what the cost of these meetings you're holding is in terms of the time and the cost benefit of the people being there, you'll see a lot of these meetings can be costing you tens of thousands of dollars a month. And if your consensus process isn't delivering tens of thousands of dollars of consistent incremental revenue or bottom line improvement, then it's bad business. Thank you for that question, Jeff.
Let's talk about statistical forecasting.
Yeah, briefly. And I say briefly just because with AI and ML and all these conversations and the various competitions that we see going on, I think a lot of people are relatively familiar with statistical forecasting. But there's basically just two pieces of this I want people to leave with. The first is, first and foremost, I'm a huge proponent of statistical forecasting. It's better than humans in nearly every instance. But no matter how sophisticated it is, and there's consultants and software companies who do a great job of making it seem like the thing that they're using for statistical forecasting is somehow cutting edge. Ultimately, even if it's machine learning, it comes down to mathematical premises that are 50 or 60 years old, which doesn't make them bad. It just means, let's be honest, they're not brand new. And they're all predicated on the same idea, which is that if I examine patterns in the past, whether it's in demand or material movement or anything else, then we can make assumptions about these patterns continuing into the future. Doesn't matter if it's autoregression or time series or causal, all statistical forecast models ultimately rest on this idea that if it happened before, some version of this is going to happen again in the future. So that's number one. Number two, on the next slide, is there's a ton of benefit to statistical forecasting. It doesn't really have a lot of bias. It doesn't have, it makes use of complex data in a way that humans can't. It differentiates between noise and patterns. It's scalable. So my software doesn't care if I'm looking at 10 SKUs or 10 million SKUs. My processor probably will, but it's scalable in a way that humans aren't. And it's got low latency, right? So it doesn't take me hours or days or months to get these inputs. It just processes. This is all good stuff, and all of this directly addresses the deficiencies in human capability. But the thing that it can't do is it can't predict what hasn't happened. So the best it can do is look at history and make assumptions about that history and predict it into the future.
And
that's where humans.
Yeah, the good thing is that they understand seasonality and that kind of stuff. So that's what they're good at. If you have have your seasonality in your figures from the past, it will predict upcoming seasonality probably.
Yep.
It's all right, but we want to enhance it with the human input, and then what?
Yeah. So this is, in some cases we shouldn't. In many cases we shouldn't. We want to enhance it with human input, but again, unless I'm measuring what the effectiveness of those human inputs is, I could very well be making it worse. The upside of human inputs, or we can call it business intelligence or judgmental forecasting, is it is highly responsive and adaptive to changes and anticipated changes in the market landscape. It can, if done properly, identify one-off events. And it can draw from many different areas of expertise. So it can see changes happening before autoregression can see it happening. So that's a benefit. The problem is humans are really, really bad at predicting the future. We're heavily biased. And the problem is most of our biases exist in unquantified ways. So we are unaware of just how biased we are. And that's the major deficiency of human inputs.
So one-off events that can be launches of new products. You have high hopes that we'll be doing fine, or promotions, that kind of stuff.
Yeah, new products are a great example. Everyone talks about how hard it is to create new product forecasts, and it is, but I think it's harder than it needs to be, especially again because of this type of a bias called the endowment effect, where anytime we spend effort on something, we impart in it at an unconscious level this inflated sense of value. So every time we're launching something, we don't often launch something with bad hopes of its success. So we tend to overestimate, for instance, how good a new product is going to be. But this applies in virtually every situation where a human is involved in forecasting. And I think some of that is selection bias. I think the type of people that we get involved in forecasting and the type of feedback loops that we reward and emphasize in corporate culture tend to reward positive biases. We don't like hearing negative outlooks for the future. So even if we don't explicitly say it, there's an implication that positive forecasts tend to be more rewarded behaviorally than negative forecasts.
I hope that people applaud the negative people, who are warning you for risk, because we are in uncertain times. So I think we should reward the people who are downplaying it. That's my case. But let's talk about biases.
We should, but it isn't often the case.
No. Let's talk about biases in the next few slides, and then you explain it. First, you have a ton of research and tons of data. Let's explain how you come to all this kind of wisdom.
So the idea of these unconscious biases is about 5 decades old, and it was really formalized in work from Daniel Kahneman and Amos Tversky beginning in the early 1970s. And ultimately, although Tversky had passed on, Kahneman won a Nobel Prize for it in 2002. And then he collaborated with some other researchers in the early 80s to sort of expand the idea. But basically, the basic premise of Tversky and Kahneman's seminal work, and then the work that followed them, is that the idea that we have from classical or neoclassical economics is that humans are rational actors. And if we give humans clear value-based choices, humans are going to rationally choose the choice that has the greatest utility to them. And anyone who's taken economics will recall hearing this. The problem is, when COVID strikes, suddenly people hoard toilet paper, even though there's no shortage of toilet paper. Now, in neoclassical economics, we'd say that's irrational behavior. But the problem is, these irrational behaviors happen all the time. It's not like it's rare. Humans do crazy things all the time. And what Kahneman and Tversky were trying to unlock is, well, why is that? So they really looked at decision-making more from a psychological standpoint than a neoclassical economic standpoint. And what we wanted to do at NorthFind was to understand, in all of these cases where we're looking at organizations who have invested a lot of time and effort and money, frankly, into their demand planning processes, why are humans given the opportunity to undo the good work in so many cases? And why, in cases where humans could add value, are they still inadvertently not adding value? So we worked with some neuroscientists and a colleague of mine, Dr. John Burkhart, who's just recently published a book at Columbia and lectures on risk at Harvard, worked with us to create this unconscious bias assay for planners. Our first client ever was the Heineken demand planning team. And we worked with over 100 of their global planners to look at the prevalence of biases in their planning processes. From there, we added other large organizations like Dell and Microsoft and Staples and Walmart and many, many more that are much smaller. And in all, we have more than 1,000 people we've talked to look at how prevalent are these different types of biases in professional demand planners globally. And for anyone who's interested, you can see our findings that have been not only published and peer reviewed in Foresight, and actually Jeff Baker, who just asked the question, was one of the peer reviewers. That's from the Q2 article in 2021. Also, interestingly, anyone who's interested in seeing their own biases, or maybe if you're not too frightened to see, we've got a short version of the assay online that you can access by going through this link, and we'll come back to you within 48 hours with your own analysis of your biases. The reason that's important is because, again, if you look at the way that statistical forecasting and judgmental forecasting can marry with each other, Humans can directly address the deficiency of statistical forecasting, which is it can't predict the future or it can't see things that haven't happened. But we only want to use human judgments in a way that don't add additional bias. And the only way we can really do that is if we understand what the biases we have are in the first place. So if we go to the next, go ahead.
Yeah, no, go ahead. You have a few slides next, and you explain different kind of biases.
Yeah, exactly. So there's basically, according to Kahneman and Tversky, three major heuristics or mental shortcuts that the brain uses, which basically have two evolutionary purposes. The first evolutionary purpose is the brain is a huge consumer of calories. And in times of caloric restraint, as in when we were cavemen, struggling just to survive, the brain evolved to try to limit caloric expenditure. So it tried to reduce energy consumption wherever it could. And the first way that it does that is by, rather than using a lot of processing power on every single decision, it tries to break it down into shortcuts. And one of the most common ones is something called the availability heuristic. So it says, I think I've seen this before. I'm not going to process this. I'm going to use the shorthand that I've developed for this type of situation to come up with my conclusion rapidly. And the second thing that the brain does, or that developed evolutionarily, is we have to navigate between 30 and 35,000 decisions a day, depending on whose research you believe. And if you're actually thinking deeply about all those decisions, you're not going to get through the day. So there's a very good reason that the brain uses shortcuts. There's a reason that the brain goes, oh, this jumped to the front of mind, this must be the right answer. That's something called the availability heuristic. The representativeness heuristic is, I've seen something like this before. I'm not going to process this. I'm just going to jump to the conclusion. These heuristics give rise to hundreds of different, let's say, flavors of biases that all kinds of different people have named. I'm going to talk about a few of them right now, but there are hundreds, and all of them impact all of us, not just demand planners. The first is,
before you get to the second point, I read an article that's almost 20 years ago that says, 50% of your calories being burned is by using your brain. So that's the reason why people who are worrying a lot don't have much overweight. And that's also related to this.
But it's exactly true. The brain is when you're using it, the brain is a huge consumer of calories. And it really, you can see the head physically get hot when you're doing deep thinking because it's burning all this glucose. But the problem is the prefrontal cortex, the part of it that we use for thinking about the future, didn't actually stop developing until we're 25 or 26 years old. So we've spent a good part of our life not using the part of the brain that we should be using to think about forecasting. So we're actually naturally in the practice of using these reflexes or heuristics when we actually should be considering them deeply. So some of these...
You go ahead to the next biases, otherwise we...
Yeah, so some of these biases that impact us are naive diversification, which is the shortcut that says, if I'm choosing all of the same thing, it must not be right. So I want to diversify my choices. We see this in financial planners all the time. We see this in people taking multiple choice tests. It means we're no longer really considering what is correct. We're considering what looks correct. And again, this moves us away from value creation.
You were spreading.
Exactly right. Next one. The next and most common bias type, and Kahneman said this is the most pervasive of biases, is overconfidence. This is where we've got an unjustified certainty in the correctness of our opinions. So confidence is okay. Overconfidence means it's not borne out in actual performance. And we see in our assay that about 2/3 of everybody has overconfidence to some extent. But when we look at professional demand planners, that jumps up to 3/4. And one of those clients I was talking about at the outset, and I won't say which one, we worked with nearly 100 data scientists, all of whom had a PhD in either economics or econometrics and math. And the overconfidence in that organization was almost off the chart. It was like 98%. But when we looked at actual demand planning performance, it was no different than anyone else. Another version of overconfidence that a lot of people will have heard of is something called the Dunning-Kruger effect, where there's an inverse correlation between experience and overconfidence. So the less I know, the more certain I am that I'm right. The reason that overconfidence really matters when we're talking about demand planning is because if I'm overconfident, I'm probably not likely to be listening to other people's opinions or to be considering the possibility that I'm wrong. And when I put myself in that position, that's really where I'm putting myself in a position to probably be adding negative value to a forecast, because I'm not going to be right all the time. I need to be open to be considering other possibilities. Cluster illusion bias is a version of that representativeness heuristic where we're paying demand planners to find patterns, and they find them even when they don't exist. Again, if we look at the average person, around 60% of people have some degree of cluster illusion bias, but when we look at professional demand planners, that jumps up above 70%. And this is exactly why, in most cases, we want a computer to do the work on math. The idea that a person can eyeball a scatter plot or eyeball a line graph and say, oh, yes, I see seasonality. This is clearly seasonality. It's just untrue. It might feel correct, but humans are just really not good at actually identifying patterns. And oftentimes they will find patterns where they don't exist. So this is definitely a clear case where we want to let computers do the work. I think we're talking about two more. Framing effect is a really, really important one. And this is basically one where if I'm interpreting data, I might interpret it one way until I hear a story about the data, and then I interpret it a different way. And we found this with virtually all of the planners that we've talked to over the years. When we present them with some randomly assorted data, in the initial raw data instance, 18% of people have a positive interpretation of the data, 39% are negative, and 23% are ambivalent. Once we frame the data, so we tell a story about it, even though the story is completely unrelated, 52% of people, because it was a positive frame, 52% of people took a positive outcome on the exact same data set. This is a really, really critical insight because, again, going back to my earlier comments on human inputs, in organizations, we tend, either implicitly or explicitly, to reward positive outlooks on demand plans and forecasts. One of the most common ways is if demand planners are aware of what the budget is, there is this unspoken need to have the forecast magically hit the budget. Even when we're aware of this, it still can happen unconsciously. The framing effect is very, very powerful. And if we had more time, I could tell you all kinds of interesting experiments that Kahneman and Tversky did in framing completely unrelated sets of data, where just mentioning a number earlier in the day would have an impact later on a completely unrelated activity. But framing effect is super pervasive, and it's definitely reinforced by a lot of the cultural biases that exist in organizations.
Maybe you have time after in the after talk. We have more time.
Yeah, sure. Yeah. The final one I want to talk about, and again, there's literally hundreds. And our assay tested for 25 different bias types. And again, anyone interested can look at the work that's published in Foresight, is optimism and pessimism. So when we look overall at the outlook of demand planners globally, about 54% of them have a persistent positive bias, and about 40% of them have a persistent strong positive bias. What this means is they will tend to interpret neutral data through a positive lens. About 20% of planners had a negative bias. This is an interesting one, where you can see there's sort of like a gradual expansion of the positive bias, whereas for planners who have a negative bias, it tends to be strong. The hypothesis here, and it's going to sound funny, but I've been a planner, so I've lived it, is I think planners who have lived long enough in an organization will tend to have been wrong so many times they eventually give up the positive outlook and start to have a strongly negative outlook on forecasts. But I think in general, we tend to self-select the type of planners who have positive outlooks because they give us the kind of answers that we want as an organization. So it's not particularly, I think there's probably two elements here. There's the selection bias in the type of people we choose, but on top of that, it's reinforced by the types of the kind of culture that we have in organizations that rewards positive outlooks.
So knowing all this, what should we do as a company?
Yeah, so the number one thing you need to do is, before we even get into limiting the downside of human judgment, is understand how much bias you have. You can't begin to correct bias if you don't actually measure it in the first place. So I think it's critically important that we're aware of bias, and that through the awareness, we actually measure how prevalent it is in the organization. But short of that, just recognizing that all human input is going to be fallible. Number one, choose where we're going to have inputs. So if we look at our portfolio, we'll know that there's SKUs that are going to forecast better statistically because of the relative stability of the demand signal, and SKUs that are probably going to forecast worse statistically, where the probability of a human input it being better than a stat forecast is higher. So that's, if we look at the quadrants 2 and 3, these are more stable SKUs versus quadrants 1 and 4, which are less stable SKUs. That's sort of the split on human judgment versus statistical forecasting. But then, because at the end of the day, our goal isn't accuracy, but business value creation, I don't want to be spending human input on SKUs that aren't making me any money. So I want to be looking at the SKUs above that horizontal line where they're generating 80% of the profit. And I did notice one of the questions that came up is, if value add is the driver, is weighted MAPE a better driver than MAPE with cost as the weighting factor? I would say Victor Wilson, short answer is I mostly agree, absolutely. If you're going to use MAPE, I love weighted MAPE. I love weighted bias as well. I don't use cost as the weighting factor. I use profit contribution. We can have a separate conversation about that in the breakout room. But yeah, financially weighting your error metrics is absolutely a better way of ensuring, just like in this segmentation of your portfolio, that you're focusing on the stuff that moves the needle financially, not arithmetically. So if we go to the next slide, this is going to pick up on some things that our friend George Box said. Don't sweat the mice when there's tigers around. So in so many cases, we make adjustments to the forecast where the scale of the adjustment is well inside our error margins. So again, every time we make an adjustment, we have to remember we're probably going to be wrong. It's important to remember that. Even if we think we know the future, there's still a pretty high probability we're going to be wrong. So if we intervene, we need to do so at a time when we know something that math or statistics or computers don't. So we have to absolutely be specific about what the difference in the future is versus the trend signal. That's number one. And all three of these criteria should be met in order to minimize the downside risk of human judgment. The second is that the SKU that we're adjusting, or the item or the group or the family, needs to be sufficiently valuable to warrant intervention. So this really speaks to that business value creation. If I'm adjusting a SKU that's generating me 10 euro of profit in a year, the cost of the intervention is going to be greater than the upside once I've adjusted. So I only want to be adjusting SKUs or items or families where there's enough money to make it worthwhile. Human time's expensive. And the final thing is the scale of intervention needs to be significant. So when I mentioned earlier that we've got decades of research showing that something like 80% of human interventions don't add value, this is because the kind of interventions we're trying to make are too minimal to add value. If we're inside the margin of error, there's literally no point. If we've set up our supply chain policies properly, we've already dealt with that margin of error with other policies besides forecasting. So I really only want to make interventions when it's going to significantly move the needle.
So we have just 1 minute. Yeah.
Yeah. The final thing we can do, so if humans are always going to be wrong, just like computers are always going to be wrong. So what we're doing is trying to ensure that what we're doing is maximizing the probability of a positive financial outcome. Number one, keep the process as simple as viable. Number two, measure the impact of every single element of the forecast process using forecast value add properly. Ultimately focus on financial impact not forecast performance. Be judicious with human judgment. So humans want to get involved in a lot of places, but they really shouldn't. And finally, when humans do get involved, make sure those interventions matter. They need to be at a substantial financial and mathematical scale.
All right, this is an overview of supply chain and media created. What kind of software do you have? You have ERP and all kind of stuff. I don't go into this because we don't have time. Q&A, we already have some questions answered. There are some more questions being asked, but I would presume that if you want really talk to the expert or thought leader about this, go ahead right after this. Join us after the end of this webinar in a minute, and then you can talk to Jonathon directly. We will be sitting at table number 1. Like Jonathon mentioned, on the right-hand side, you see a checklist of forecast value add. We created together 10 painful questions, yes, no. If you understand all this and your colleagues at sales and finance understand this, download it here. There's an online assessment, like Jonathon mentioned, and you get within 48 hours, you get feedback on your performance, and there's the contact details. Good news, Jonathon will be live on stage in the Netherlands during SNP Flavor Day. He will talk about forecast value add, and there are 2 companies who talk about forecast value add, Bonduelle and Trust, and they will have a discussion on stage with Jonathon about all this, and we get more insight from practical matter. For this, I have a lot of questions still downloaded here for myself to be asked for Jonathon, but unfortunately we don't have time. But I would like to thank the audience for asking these questions and attending this either live or watching the recording. But last but not least, Jonathon, thank you for all this, giving me better understanding in a nice way, kind of lecturing me about forecast value.
Yeah, absolutely. Always a pleasure to talk about this really important topic.
So, we are over time, but, I hope you like this and you will download this and learn from this and practice all this. And, maybe you can preach this to your colleagues and, make some more out of this forecasting value add exercise and experience. Thanks for now, and hopefully I see you in the lounge right after this. If not, I hope to see you at the SNP Flavor Day in the Netherlands or in the next webinar. And I would say bye-bye.